Please, baby, come on home. Please, baby, come on home.
Hey everybody, welcome back to this week's Teaching Thursdays. We're going to talk about a topic that we've kind of brushed on before. We talked about portfolios and diversification. So we're actually going to create this little diversification web here using a mock portfolio to kind of explain more and really get into about, like risk tolerance and things like that. So how much are you willing to withstand in terms of gains, losses, etc. So, let's say we have our mock portfolio here. This could be yours, this could be mine, this could be anybody's. So let's say we have a mock portfolio here. And now in the stock market, there's going to be different sectors. So you're going to have sectors like technology. You can have financial. You're going to have other sectors. So you're going to have your like consumer goods. Consumer goods are simply going to be, things that we consume. So, we're thinking about like restaurants, clothes, retail space, things like that. What else do we have? We can have transportation. Let's just put transpo on there. Transportation. So these are some different, sectors, industries on here. And actually, let's go ahead and just throw a bond at the bottom. We can talk about the difference with those as well. So let's just put bonds down here. So this is our mock portfolio here, and we got it, somewhat diversified because we investing in financial entities, we're investing in technology entities, we're investing in consumer goods, we're investing in transportation, and we're also investing in bonds. So, this is a good start to some diversification in your portfolio. It doesn't necessarily have to be these sectors and industries or these securities, but this is just a mock example. So, within our portfolio, so now let's break that down even more. Let's look at some companies that would be under these sectors and industries. So, in finance, we're going to have banks. So, let's say you have Bank of America, which is BAC. You can have Wells Fargo, which is WFG. In your technology, maybe you have Facebook stock, and then maybe you have Cisco. In consumer goods, let's say you have, you shop at Macy's, and then maybe you like to eat at, Buffalo Wild Wings, or matter of fact, let's say Wingstop, since Wingstop has an IPO coming out tomorrow. That's going to be under Wing. Then with your transportation, you can invest in, companies like UPS. You can invest in Delta Airlines. There's trains, so you got CSX. And then in your bonds, let's say you have, 3 different bonds. You have a corporate bond, corp. You have a municipal bond, or a muni. And then you have a treasury bond. So now, we're looking at our portfolio and we're like, oh, okay, we got a couple of holdings here. We're getting a little diversified. So we're talking about in financial markets, we're talking about banks. Now, if you think about it, banks pretty much do the same thing all the time. Banks, they pretty much are banking on interest rates to make their money, and the Fed is actually talking about raising interest rates, later on this year. So that is faring well for the financial industry and institutions in there. So, but these are considered, your more safer investments that actually act with the economy. So if the economy is doing bad, then, financial institutions aren't going to do as well. If the economy is doing well, then the vice versa. So these are going to be your more safer investments. So then you have technology over here. Technology is a little bit more riskier. It doesn't really depend on the economy because technology is constant innovation. It's constant things going on out here. So that's going to be your more riskier stocks. Now, technology stocks tend to have higher valuations or stock prices than your financial stocks, but that's not always the case, but that just tends to be true, or at least in terms of what the stock price is compared to what the company actually makes, simply because they're putting all their money back into the innovation of the company. And then down here we have our consumer goods, so we have Macy's and we have Wingstop. I would say that these are probably going to be, roughly in between here, simply because they're safe in that people are always shopping, but people aren't always shopping all the time. And the same is also going to be for transportation. People tend to fly more than they usually do at certain times in the year. People tend to ship packages more than they usually do at certain times of the year. So I would say that these are going to be more of a mix. But consumer goods, you think about consumer goods, some consumer goods actually act with the economy. People aren't going to eat out as much if, if inflation is high or if prices are, more for certain goods. But at the same time, if you think about, something like a Whole Foods or a Kroger, people still got to go to the grocery store. So Kroger is still going to thrive maybe while Wingstop and Macy's maybe takes a back seat. And then, transportation, as we said, that's going to be a mix over here as well. So if we look at bonds, your treasury bonds are going to be the safest bonds that you can get. However, they pay out the lowest coupon or interest rate back to you. So if you have a treasury bond that's worth $1,000 and maybe you're getting back a 3% rate, then you're only going to get $30 back on that for the year. So this is going to be safe. But then if you have a muni bond is actually safe like a treasury bond, and it has some tax advantages to it, but it's not as backed up as like the government treasury bond would be. This is going to be your more local, your state, city official type bonds going on right here. A lot of investors want muni bonds because they have great coupons, they pay high rates, but it's not that many of them. So that's going to be your mix right here. Probably mix closer being to safe. And then you have your corporate bonds. Your corporate bonds are going to be the riskiest bonds you have, because if you think about it, if a corporation goes out of business, mind you, your bond lenders are going to get paid first before the stock shareholders. However, if the company goes in default and they can't pay you back, then you're out your money. So this is going to be your risky bond. So now if we're looking back at our portfolio, we have some safe stocks over here. We have some riskier stocks over here. We have a mixture of safe and risk down here. And then we also have from safe to risky in terms of bonds, which bonds are actually safer overall than your stocks are going to be. Bonds have a limited upside, but they have a extremely limited downside as opposed to what the stocks are going to do in the stock market. So this is what we would call diversification. Not only are you investing in several different companies, but you're investing in several different kinds of companies. They're in different industries. They have different products. They have different services. This is what diversification is going to be. And of course, with some of the safer stocks, those are going to come with dividends usually. So because they're safer and because they have less upside than maybe a technology stock would, they're going to have dividends. Now, that's not to say that every technology stock doesn't have a dividend, but some of these stocks are going to have safer with it. The same thing goes with these. Some of these might have a dividend, some of these might not have it yet. It just kind of depends. So if we want to tie all this together in terms of with the music industry, we could say that your portfolio could be your playlist within, whatever streaming service that you're using. And if we look at the different institutions or different industries and sectors here, as well as with the bonds, that's going to be the type of music that you have within your playlist. So maybe your financial could be your hip-hop music, and your technology could be your country music. And your consumer goods might be your alternative music, while transportation might be blues. You might have an eclectic background in terms of what music you like to listen to, so you're going to have a diverse selection of music to choose from. Well, that's exactly how your portfolio is going to look as well when you invest in different areas. Now, some people like to invest in a sole sector or a sole industry and focus on that. It all just depends on your prerogative. But usually with diversification, it's a way to limit the downside or limit the risk that you may have, while still being able to take a couple gambles on companies that are riskier, while the safer stocks and the ones with dividends are kind of offsetting any losses that you may accrue. So that concludes it for this week's Teaching Thursdays. We hope it was an educational lesson as we dive into more of the portfolio and diversification. We even have the web for you. I would definitely recommend you to set up a spreadsheet or even, write this out for yourself just to kind of see how you're doing and how yours is set up in terms of your portfolio and how it's spread around, because maybe you should start getting into other things, or maybe you should cut some things out depending upon if they're hurting or helping your portfolio. Peace.